Well, good afternoon, everyone. This is Tony Whitbeck. I'm the CEO of Key Management Group. And with me today is Todd Doherty, and Todd is our Director of Acquisition and Legacy Planning and our resident expert. Today's topic is business valuations and understanding what drives practice value. And Todd's going to be taking you through the majority of today's content. But before we do that, I would like to spend just a couple of minutes giving you an overview of the services that are offered by Key Management Group. So when I think of the services we offer, I like to think of them in alignment with different stages of an advisor's career. So usually when you start off as a solo advisor, and you're responsible for acquiring clients, client service, really everything in the practice. So our executive coaching program is a program that can help you grow your business, and we help you in all aspects of your practice. You may want to outsource some of the services since you have no staff. So we do client meeting preparation or case preparation and financial plan production, very similar to what Practice Source does at Ameriprise. And then we have our guardian or continuity plans to help protect the value of the practice in the event of your death or disability. Once you become an advisor with support staff, you're going to be more focused on things like organization, systems, delegation, roles and responsibility. And so our practice management service is really designed to help you streamline and become more efficient, and to have everyone on your team understand what their role is in the practice. In addition, at this point, oftentimes people are interested in starting to acquire other practices. So we have an acquisition consulting service that can help you design a strategy to acquire practices. The next stage then is a team practice. And this is oftentimes where you're going to either partner with someone else or bring on AFAs to serve or acquire clients. And you're now needing to think more like a CEO. You're worried about building your brand and protecting the equity that you have. So we have an incredible service called our AFA analysis that will help you design a compensation plan for your AFA, and we'll look at all different aspects of it, like should they be a W-2 or a 1099, independent contractor, should they be paid on variable compensation or a salary, what are all the expenses, and then ultimately how do you make this profitable for you and for your AFA. And then we offer succession planning for those that are thinking about building a succession plan. They're not ready to retire yet, but it could be an internal succession plan. And then we have our advisor legacy platform, where you can be a buyer on the platform and you'll be notified when we have sellers, and then you can participate in an acquisition. Our advisor legacy process also works for sellers, and so we represent sellers on the platform as well. So the final stage of an advisor's career is the transitioning phase, where they're trying to find the right successor, negotiate a deal, and then transition their clients. So our advisor legacy service offers that. We really act as the seller's agent to help them find the best buyer for their practice. We also have a deal-making service, and this is when the buyer and seller have already found each other, but they would like some help valuing the practice, negotiating the deal, and having all the legal work done. And then finally, we offer an escrow service, which is usually used in conjunction with bank financing, and it's used to hold a portion of the purchase price in escrow, typically until the attrition clause has been met. And then last but not least, we have our business valuation service, which is what we're going to talk about today. And really, our business valuation service can be used in all stages of your career. And there's a lot of different reasons why people would buy a business valuation. And so what I'm going to do is turn it over to Todd, and he's going to talk a little bit about that and then take you through how to look at valuation and how you can drive practice value. So Todd?
Thank you, Tony. And it looks like we've got a big group today on the call, and thank you all for joining us as well. As Tony mentioned, business valuations really span the scope of an advisor's career, and they're used in very many different areas, some of which are beneficial to advisors and others are actually areas that require a business valuation like bank financing for an acquisition. So as you can see on this side, there are a number of items that we commonly provide valuations for. Charting the value of your practice, or another way to look at that is managing equity. Probably one of my favorites, and we've really had some amazing results helping advisors grow and manage the equity in their practices over time. And it's pretty satisfying to help people with that kind of growth and equity. And it usually corresponds to growth in efficiency and profitability as well. People certainly use formal valuations for buy-sell or continuity agreements for death and disability. Certainly for succession planning. We're seeing a lot of valuations these days for teaming considerations where people are, forming more complex practices and perhaps sharing equity and so forth. We certainly do quite a number of valuations for the lending institutions that fund acquisitions in the industry. And most of them require what's known as a certified valuation, certainly those that are doing SBA lending. We also do what we refer to as specialty valuations, and those are valuations that require a different deliverable than our standard fair market value deliverable. Some of those items that are more common include valuations for divorce. We do quite a bit of divorce valuation work for advisors. Anything that requires limited marketability is usually a separate valuation. So if there's a partnership dispute or something like that, we can do those as well. And minority ownership situations oftentimes require a different deliverable as well. And we can do all of those types of valuations as well. We have a CPA analyst on our team who holds 2 certifications in valuation. He does all of our specialty work. So let's take a look at how valuations are completed, what are the primary considerations, and really what drives the value in your practice. A practice sale is considered what's known as goodwill, and really what's being transitioned in the sale is the goodwill of the clients, and to a lesser extent that of the selling advisor. You don't technically own the clients, they can come and go as they please, of course, but you do own and have the ability to transition their goodwill and the ability for someone else to service those clients, manage their assets, and receive the revenue involved in doing so. Because most practices today are large enough that if they sell, the buyer is also purchasing the ongoing operations of the business, which is what's known as enterprise value. We also look at not just the goodwill of the clients and the quality of the client group, etc., but we also need to consider what's known as the enterprise value these days. That's the efficiency or lack thereof of the practice, the resulting profitability. And that's become a more heavily weighted item over the years as practices have gotten larger and larger. And really, client group sales are quite rare anymore. It used to be fairly common that someone could buy a smaller group of clients, didn't really come with any existing expenses per se. But those situations are actually the exception and not the rule now, and larger practice sales are the rule. In fact, our average valuation today is $1,700,000. So because we need to consider really 2 types of value, we use 2 different approaches of value as well, and the value that we assign to a given practice is the average of those 2. So the first approach that we use is what's known as a market-based approach. And in that approach, what we're doing is we're looking at the key metrics of the practice being valued. That would be things like the quality of the revenue, is it recurring or transactional, client age averages, length of relationship, client segmentation. A lot of the key metrics is what we're measuring, and we're comparing those to our benchmarks. And in doing so, we can determine where is the practice above or below average, based on the overall quality assessment, we can compare that practice to recent sales of a similar quality practice. The other approach is what's known as an income approach, or also commonly known as discounted cash flow. And in that approach, we're valuing the future revenue stream of the practice discounted for time. So we're building up an assumption of the long-term growth of the practice. We're applying a discount rate based on the time value of money, and that discount represents the risk and opportunity cost of the practice. And then we're using the practice existing expense ratio to determine what the net earnings are and calculating a value of that income into the future. So again, the average of those two results is the value that we'll assign, and what that value result is intended to show the advisor is that would be the average of the actual price that we would expect to see in the marketplace. We have quite a bit of validation around price. As Tony mentioned, we sell practices. We do a considerable amount of consulting and acquisition and succession. And in that, we also do valuations for the lenders in the industry. We're really seeing deals on, pretty much a weekly basis, which keeps us very well connected to the price that's being paid for a specific quality of practice in today's market. A lot of people ask, how is it that we determine the quality of the client group? And certainly there are a number of, metrics that you can look at to determine that, averages of client size, GDC, AUM, and so forth. But really, the foundation of the quality of the client group can be broken down into client segmentation, and it's one of the areas that we spend a lot of time focusing on and analyzing. So as you can see on this slide, we're going to take the clients of the practice being valued and break those into three different segments of clients. First, we have what we refer to as basic clients. Those are the clients under 100,000 in AUM. Then we have the high value group between 100 and 500,000. And last and most significant, the affluent client group that are over 500,000 in AUM. As you can see on the slide here, those three segments represent, in an average practice, 44% of the clients are in the basic group, 38% of the clients are in the high value group, and 18% in the affluent group. The real significance of client segmentation, and the reason it's so highly correlated to both efficiency, profitability, and also the value of the practice, is primarily centered around that basic client group. Because as you can see on the slide here, that group, while they represent 44% of the clients, they only produce 7% of the GDC. So that's a very large inefficiency on average. It's also the primary correlation that we see larger practices become less profitable as they grow. The reason there being many times, practices with this average segmentation, they get large enough where they need to hire an associate advisor. They'll generally have them service the bottom end of the book. And in doing so, you've really created your largest expense item relative to your lowest productivity, and that's where efficiency and profitability start to decrease. On the other hand, the practices that are the most valuable, the most efficient, and the most profitable will generally maintain around 25% of their clients in that basic group, and it very rarely goes lower than that ratio, which is a really interesting data point that we've noticed over time, because it would seem to represent that 25% is probably the appropriate size group for the clients under 100,000 in AUM. There's another significant item on this slide that you'd probably want to pay attention to, and it has to do with the dollars of GDC for each of the three segments. So you can see that basic clients on average produce around $400 a year. High value clients produce $2,200, and the affluent group produces over 8,000 on average a year, which is why that small affluent group is the majority of the production and assets in any given practice. The reason that those dollar figures are so significant is they dispel the common myth that advisors have, or assumption that you can have as many clients as you want as long as you don't spend an equivalent amount of time with them. The problem with that assumption is that differences in time are nothing compared to the differences in dollars. For example, if you compare your high value clients to the basic group, it's 5 times the revenue. If you compare your affluent clients to the basic group, it's 21 times the revenue. And certainly you're not allocating time and resources that have an equivalent multiple that the revenue has. And so managing that basic group is critical, and it is really the key to increasing the quality of the client group overall, increasing the profitability of the practice, and also its value. We did an interesting study at the end of 2018, a bit of what you would refer to as a regression analysis, looking at all of the data points that go into our valuation model. And certainly there are quite a number of data points that we consider in the valuation. But what we were trying to find out from the data is, of all of those points, which of them have the strongest correlation to a valuation result? And that's both a positive result and a negative result. And what we came back with is what you can see on the slide here, is that the 3 top items with the highest correlation to a positive result, and in this order, are recurring revenue. That was number 1. And recurring revenue has been an interesting data point in that it's gone up pretty significantly over the last 4 years or so, where the average is now 87%. And that's about a 10% increase over that time frame. And we're seeing very, very few transactional practices these days. The second item is operating profit. Probably not a huge surprise, given that enterprise value has become such an important consideration now. And then the third item is the percentage of high net worth clients, which, as you have just seen on the previous slide, are very critical to the overall profitability and efficiency of the practice. So number 2 and 3 are probably very closely related. So those are the 3 top items that drive value, and based on that, those are the 3 that, if you are going to improve the value of your practice, would probably be, the most common items to focus on. The interesting thing about those 3 of the positive influence points is they're very manageable, unlike a lot of points which are not quite as manageable, but those 3 are certainly manageable, and we've seen practices make huge improvements over a relatively short period of time of only a year, or certainly 2 years. On the other side of that coin are the value detractors, or the negative data points that have the strongest correlation to a poor valuation result, or a lower valuation result, probably more appropriately. So those, again, in the order of their correlation, are the number, or probably more appropriately the ratio of low value clients. Those are the basic clients under 100,000. The age of clients can be very significant to the valuation. And we're seeing a lot of practices that have really hit what I would refer to as a tipping point regarding client age, and that's where the high value and affluent clients are at or near the average of 70. The significance to the value is it certainly increases the risk, but it also very sharply decreases any kind of a growth rate assumption that you might have for clients of that age range. Typically, those clients are no longer rolling over assets. They're more likely in their distribution phase with the advisor. And then you're losing, assets through clients passing away and so forth. So that's very central consideration regarding the value. And the last item is probably a bit of a surprise to many, or at least a little counterintuitive, and that has to do with the number of professionals in the practice. As I mentioned before, practices on average become less efficient and less profitable as they grow. And the primary reason for that is also what we discussed in the segmentation section, where instead of managing client segmentation and creating a more efficient practice, people are simply hiring associates and then creating structures that actually detract from profitability. And that's one of the primary items we see where, some of the really large practices that you're probably aware of in the rankings might have expense ratios in the 60 and 70% range, whereas very highly efficient practices will have expense ratios in the 30% range. So it's quite a difference, and it really impacts the value of an advisor's time. A good example of the range of value, and this is, one of the things that's not well understood, I think, what we see in the marketplace and even in our own practice sales is many of the buyers are using simple methodologies of value to actually value an acquisition. And they're using multiples of revenue. They might think, there's an average of 2.7, times recurring revenue and 1 times transactional, that sort of methodology. But it's a dangerous game to play. And the average valuation, again, is about $1.7 million, but the range of value for that average size is around $400,000. So when you're using more simple methodologies versus a formal valuation, the chances of you being accurate are very slim. And generally speaking, you might be off by a few $1,000s, but you could easily be off by 100,000 or more. And looking at these two examples on the slide is a good illustration of why that might be the case. So we're looking at two practices that are very similar in scope, GDC of 619, practice 2, GDC of 621, assets of 70 million versus 74. But once you start diving into the quality differences of the two practices, that's where they really start to separate. So if we look at recurring revenue, number 1 is strong at 86%, number 2 is stronger at 96%. And these are actual results from valuations that we completed, by the way. Operating profit, big differences here, 22% for 1, 57% for 2. High net worth clients, 14% versus 45%, huge gap there. And then if you look at the negative detractors, you've got a lot of low-end clients, you've got a larger group of older clients, and more professionals in practice number 1. So again, starting out and looking at practices that appear to be fairly similar, you see the net result is number 1 has a valuation of just slightly north of $1 million, and practice 2 has a valuation closer to $2 million at $1.7 million. If you were to apply simple methodologies of value to these two practices, the results would have come out very similar, but when you apply a formal valuation methodology, you can see that the differences are very, very significant there. Again, we talked about the range that we see in our own valuation deliverables, and you can see more specifically what that range is here and why, again, it's not a good idea to use rule of thumb or average types of valuations. So here you can see the average practice that we've completed a valuation for, and this is based on almost 500 valuations, is 780,000 in GDC or revenue, assets under management of 100 million, and that average valuation for that size practice here came in at $1.6 million. Again, looking at the bottom and top 20% of value applied to that average size, the top 20% came in at $1.8 million, the bottom $1.4 million. And so we see a range between those two of almost 400,000. And again, hopefully that just really reinforces the idea that you don't want to use averages and you want to get a formal valuation really completed for any significant consideration, whether that be managing equity, certainly for succession or acquisition, anything that really requires, good information to make a sound decision. Really quickly on our own valuation process, as I mentioned, we use the two different methodologies of value, both the market-based approach and an earnings approach. For Ameriprise advisors specifically, we have spent a lot of time really streamlining the process. So completing our data collection is really very simple. We collect most of the data from two specific reports that we give you the instructions to find from Compass. It literally takes a fraction of the time of our competitors, where they're asking you to fill out a questionnaire and go find all those data points yourself. I mean, we have people who complete our data collection immediately after they place the order. So very, very simple, very user friendly. Probably the area where people find the most value in our specific service is that when we send you the deliverable, we'll spend an hour going through the results with you. So what we don't want is that you get the deliverable, flip to the page that has the number on it, and that's the extent of it, because there's so much good information that comes from evaluation. It could be around profitability, client segmentation improvements. We've had advisors who have literally increased the value of their practice by $1 million in a 12-month time frame, not based on growth, but simply based on managing efficiency. Another amazing success story I wanted to share is we've been doing valuations and coaching through that process of an RIA practice over the last 4 or 5 years, who now currently has a value of over 20 million, over $1 billion under management, an average client size of $1.4 million. And they started out as a fairly average practice, but now they have just an incredible result, and they've been following the changes in their practice and their strategic management through the results of the valuations from year to year. And it's just great to see those types of success stories. The cost of the valuation for an Ameriprise advisor, which is everyone on this call, is generally a discounted price of $8.95. So our standard price is $12.95 minus the partner firm discount takes you to $8.95. But we also have a limited time offer that you can see on the top of the screen, whereas when you're placing the order, you enter in the coupon code of SAVE100. That will take the price down to $7.95, and that, I believe, is limited through November. So that's our process. Hopefully some of you will order a valuation, based on what you've learned. We look forward to helping you out with whatever need you have for it. With that, I'm going to hand it back over to Tony. He'll close it out and open it up to some of your questions. Thank you.
Great, thank you, Todd. Yeah, and as it says here on the screen, limited time offer runs through November 22nd, so 2 weeks from tomorrow. Again, just enter SAVE100 as a coupon code when placing your order. In terms of how to place the order, just go to our website at keymanagementgrp.com. Under the Services tab, you'll see Assess Your Practice and then Business Valuations. And then what you'll want to do is be sure to choose the partner firm valuation for $8.95. And when you actually get to the credit card form, be sure to put in the coupon code if you do it between now and the 22nd of November. As Todd alluded to, our process is very straightforward, streamlined, easy to do. It'll take you less than 15 minutes to get us the information that we need, because we've customized it for Ameriprise based on the reports that are available on Compass. And we'll provide you instructions in the confirmation email with how to pull those reports down. So you buy it online with a credit card, then you get an email with instructions on next steps. You're only going to attach 2 reports and answer a few questions. We'll then deliver the results by email in terms of the actual valuation, and there's a sample on our website as well. And then we'll schedule the 1-hour one-on-one consultation. In a minute, I'm going to open it up for some questions, and there's 2 ways you can ask a question. One is you can raise your hand. This is on the GoToWebinar control panel. And then what I'll do is I'll unmute your telephone line, and we'll do the best we can to answer the question. The second way is you can type in a question and then I'll read it aloud and we'll do our best to answer that. So while we're waiting for some questions, I just wanted to read a few testimonials. The first one's from Randy Kreinbrink, who's an Ameriprise private wealth advisor. He says, my experience going through your evaluation process versus the other company, in other words, our competition, was night and day. This is also true for the format and the clarity of the deliverable. I can't believe the differences in the amount of time required at the level of my frustration between the two processes. Thanks again for your help, Randy. Then Jim Muma says, I did not go into the process having high expectations about this being a valuable tool for me personally. Having said that, I found the business valuation more valuable than I thought, and the hour with Todd I spent together reviewing the results was some of the most valuable time I've ever spent looking at my practice. And then finally, Paul Van de Buchen, I'm pleased with the business valuation done by KMG. The end result was accurate. The greatest part was Todd's insight. I shared this data with the person who signed a continuity agreement with me, who also was very complimentary of the attention to detail and presentation. I plan to go through this process every year to be certain the agreement is fair to both parties. So at this time, what I'd like to do is open it up to some questions, and I see that we do have some questions. And so the first question is there a practice that is too small? Todd, you want to address that?
No, I think, any size practice or even a client group, which is, we do commonly valuations for client groups, either to sell smaller groups out of a larger practice or so forth. But no, there's no size requirement for evaluation. I think it's a great idea for advisors who are just starting out, maybe, have 25 million under management, that sort of thing, but, want to get started early in the career. Managing the equity is great. So no, there's no low size limit on valuations.
As a matter of fact, we recently helped someone sell a small portion of their client base. I think it was only 35 clients, if I remember correctly. And they had us do a valuation on that small segment of their client base. So as Todd pointed out, really there isn't a practice that's too small. We have another question from Lee, and his question is, what's your fee for helping with a succession plan contract for death and disability? So I'll take that one. Lee, we actually have another program. It's called our Turnkey Continuity Plan. It includes the business valuation and the legal agreement, and that's $18.95. So you get the valuation, an hour of consulting with Todd, and then you get the continuity agreement between you and your successor, and you get an hour of the law firm's time to customize that agreement. So it's really a great deal. It's a great package. We pay the law firm to do the work on your behalf, and then they'll customize it to meet your needs. Let me see. I think those are the only two questions we have so far. Let me see if anyone else. Oh, someone has raised their hand. Andrea, you have your hand raised, but you also had typed in a question. Do you have another question for us? Apparently not. All right, well, it looks like we've answered all the questions. I want to thank everyone for joining us today. Hopefully we're going to see some of you take advantage of this business valuation service. If you do it soon, you can save an extra $100 and it's only $7.95. So go to our website at keymanagementgrp.com, and good luck to you, and thanks for attending. Bye-bye.